in a day and age where there is a regular channel and there's a direct channel, how do we make customers come to us and use the regular channel? The only way is to show them that as advisors, we have the ability to create the alpha. We have great abilities, but we need to demonstrate it, we need to put it across, and we need to show the customers that regular is going to be far more profitable for them than direct in the long run, as long as they reach out to us. That's exactly what the next speaker is going to talk about. Aashish P Somaiyaa is the next speaker. He is the ED and CEO of WhiteOak Capital Asset Management Company, a company that's part of the WhiteOak Group, which manages $6 billion of capital across Indian equities with operations in Singapore and other countries abroad. Aashish, again, is no stranger to IFA Galaxy. We've had him before. Earlier, he was with Motilal, and overall, he has had over 21 years of experience. Aashish is a BE in engineering and a master at management in finance from Mumbai University. And he is a very articulate speaker and a very powerful speaker who puts out his thoughts and ideas for all of us. As we come to the end of our sessions, I think we're getting to a more interesting place and lots of interesting things coming back. But now we have Aashish talking to us about Advisor Alpha. Over to you, Aashish.
Good evening, everyone. Thank you very much for inviting me here to speak to the audience at IFA Galaxy. At the outset, I would like to thank the organizers. I think I've been very lucky to be able to have attended each and every IFA Galaxy event over the number of years across all my roles. So thank you very much for having me over here once again. I have an interesting topic to speak to all of you today. So without much ado, I'm going to put up my slides. The topic that I have been given to speak to all of you, I think is extremely important in order to engage with clients in our industry. It is Advisors Alpha. And as I have said multiple times before, that alpha comes from being in the right beta. Let me explain that. I think that, in our industry, there is a lot of time which is spent in analyzing fund managers, in analyzing direct plans and regular plans, and analyzing individual fund managers' outperformance or underperformance versus a given benchmark. Now, what I find is that how much alpha a particular fund manager generates, I think that is secondary. Bulk of the alpha, as is very, very well known, that more than 90% of returns come from appropriate asset allocation. That is why I always say that alpha comes from being in the right beta. So let me give you another example of this. If you take a year like say 2011, 2012, or in fact, if you take bulk of the last one decade, you will find that there have been very many years where the Indian market has been extremely, extremely volatile. There have been years when we have had a 40% downswing. There have been years when we had a 40% upswing. But on the other hand, if you were to look at say NASDAQ 100 as an index, which is obviously a US index, what you will find is that in the last 10 years, prior to this recent fall, in the last 10 years, the CAGR of NASDAQ 100 as an index was 25% compounded for 10 years. So what this tells you is that while we focus all our attention on the Indian market and analyzing Indian market's performance threadbare year on year, and within that each fund manager's performance threadbare year on year, what sometimes we miss is that in years like 2012, for example, or 2015, for example, even if you are with the best performing Indian manager, what is the point? Because India as a market itself did badly. And on the other hand, if you were with the worst performing manager related to the NASDAQ index, you would have still done better than the best performing manager in India. So what is more important, rather than go hair splitting between direct plans and regular plans, and rather than go hair splitting between, which fund manager did how much alpha and whether to buy ETF, active fund, index fund, what is most important is that we should be in the right asset classes. And of course, when we evaluate cricketers, let's say we evaluate Virat Kohli as a captain, we can evaluate him for his for his captainship related to his decisions, related to team selection, related to his individual performance. But we cannot evaluate his captaincy basis how many coin tosses he actually won. So trying to forecast which country will do when at which point in time, or within a country trying to forecast which manager or which sector will do well, is extremely difficult. So what is most important is that at the onset, we determine an asset allocation and we spread our investments across multiple baskets such that at any point in time, we have the right components in the asset allocation. So that's where this notion comes from, which is about alpha comes from being in the right beta. But today, since I have an opportunity for the first time, I'm representing WhiteOak Capital. So first couple of slides, I'm just quickly going to tell you about WhiteOak. For those of you who don't know, WhiteOak is not really a new company. It was founded in 2017 by my colleague Prashant Khemka. As we speak, WhiteOak manages approximately $6 billion of assets. All of it is listed Indian equity. Out of the 6 billion of assets, roughly 4.5 billion or 33,000 crores is managed for global investors investing into India, and close to 11,000 crores is managed for domestic investors through our TMS and AIF. As you follow the pink papers or business television, you must have seen that foreign portfolio investors are large investors into India over the years. Probably you'll be happy to know that in the last 3 to 4 years, WhiteOak is one of the largest foreign portfolio investors invested into India through the global funds that we manage for global investors to be able to invest into India. So WhiteOak was founded by my colleague Prashant Khemka, like I said, in the year 2017. Prior to founding WhiteOak Capital, he used to be with Goldman Sachs, worked at Goldman Sachs for about 17 years. One of the unique managers who has managed money in US equity for the first 6 years, and then Indian equity for the next 10 years. And then along the way, for a period of 4 years, he's also been CIO for global emerging markets. So has experience of managing money globally, a very long stint with Goldman Sachs. So that's about the founder. You might be happy to know for that our India equity funds, Prashant was recently rated AAA by Citywire, which is a widely followed rating agency in the Middle East and Europe. And so how is this money actually managed? WhiteOak has its own mutual funds in Europe, in London, and in Mauritius. This is where this 4.5 billion is managed. In fact, the first mutual fund that WhiteOak launched was for European investors, launched in 2018. That's, by the way, rated 5-star by Morningstar and has a very, very solid track record over the last 3 years. So that's about WhiteOak. The first fund, like I said, which we launched, about 23% compounded return versus 14% of BSE 500, so gives compounded 9% alpha. The second one is our PMS, which we launched domestically. Again, last 3 years, 25% compounded return versus 18% on the benchmark, so over 6% compounded alpha. So that's about the track record and performance. We have a team out here, which is at WhiteOak Capital AMC. Highly experienced team. Ramesh Mantri, who's our CIO, has been with WhiteOak since 2017. Prateek Pant has been a very experienced leader in our industry, been with Sanctum Wealth, prior to that with Franklin. And of course, all of you know BY Joshi, who's our Chief Operating Officer, who's been CEO of one of the leading AMCs over the last 11 years, recently joined us. So that's by way of an introduction. Very quickly on to today's topic. When I was told to speak about this, when I was trying to understand what I should be talking about and how do I step into your shoes, I think what I learned is that there are few attributes for an advisor to create his or her own alpha over and above what we expect fund managers to create as alpha. And according to me, I mean, it's not by design, but basically what I realized that there are 4 C's for this. One is clarity, which is very important. Clarity of thought, extremely important. Second is conviction. Third is also equally important, which is to be slightly contrarian. And the ability, you cannot follow asset allocation and you cannot create alpha into your client's portfolio unless and until you have a bit of a streak of going away from the grain or going, trying to swim upstream. So I think contrarianism is important. And believe me, all of this will come to a zero if one cannot communicate. So 4 C's: clarity, conviction, contrarianism, and communication. Now, I'm not going to elaborate on each of these, but I'm going to demonstrate how all of these are relevant in today's times. So the first thing which we are seeing today in the market is that, crores of new investors, millions of new investors have entered into our industry through mutual funds, through SIPs, through demat accounts, through multiple forms and formats of interaction with capital markets. And I think all of these investors are facing a bit of a challenge on two fronts. I think one reason for this challenge that they are facing is related to the conviction in the market. Very recently we saw 18,700, and now we are seeing unprecedented foreign portfolio investors outflow. WhiteOak, by the way, is a foreign portfolio investor. We are not seeing any outflow. We are investing consistently. But I think this is more a global phenomenon. So where does conviction come in? I mean, at times like this, if you want to add alpha to your client's portfolio, how do you demonstrate conviction? That's one area of what I'm going to explain. The second is, today there is a lot of negativity with relation to the tech sector. And a lot of this negativity is based on few shares which got listed and what is their stock price. The other part of negativity is also because of US tech as a sector. So I'm going to talk to you about conviction quite a bit. Conviction in India's markets at this point in time, and conviction in India's technology sector at this point in time, because these are the two which are causing maximum headwinds in clients' conviction. So how do advisors pass conviction, and how is that also an exemplar of contrarianism? I think that is something to focus on. So coming on to the FPI outflows and what we are witnessing in the markets, few things we should keep in mind. That foreign portfolio investors over the last 30 years have consistently been big investors in India, and Indian markets have rewarded them heavily. Today, the foreign portfolio outflow has nothing to do with India in specific. It is because of the geopolitical situation. It is because of maybe the US markets, maybe because of interest rates. I think these are few reasons why globally there is a bit of a risk off as far as equity is concerned. But believe you me, no foreigner is waking up first thing in the morning and saying India is a bad market, so let me exit. In 2008, it was the same. They started selling because of US Lehman related issues. In 2020, they started selling because of COVID spread in US. By the way, India didn't have, when our market hit rock bottom, we hardly had any cases of COVID actually. And in the last few years, what is interesting is that Indian markets have handsomely rewarded foreigners. So they are going nowhere. I think this is a temporary phase, and you're going to see huge amounts of money, more than what has been removed, will actually come back. So in the last 5 years and 15 years respectively, if you see the US market has generated 16% and 8.4% compounded. The next best is Indian markets, 13.6% compounded in dollar terms in the last 5 years, and 5% compounded in dollar terms. By the way, 5% is not bad. 5% compounded in dollar terms in last 15 years. And after US, this is actually the second highest return globally that any market has delivered anywhere in the world. You can see India's contribution to world market cap is 3%, but India's weightage in the index is only 1%, and that is set to rise. What is the reason it is set to rise? Is because India is actually one of the most diverse corporate universes. We have a very low concentration across sectors in India, and very importantly, in every sector, we have large cap, mid cap, and small cap as a variety of companies. By the way, in case some of you may not know, India has the highest number of listed companies. By the way, in the US in the last 25 years, the market cap has gone 3x, whereas number of listed companies has gone down. It has become half. So by the way, in the US, the alpha opportunities have gone down because alpha has migrated to private markets. But in India, the alpha opportunity has actually gone up in the last 20-25 years. This is clearly visible. India's number of stocks getting entry into MSCI Emerging Markets Index and India's weightage in the Emerging Market Index is consistently on the rise. As you are aware already, India is going to be the third economy to get to 5 trillion. Frankly, it doesn't matter to us whether it happens in 2024 or 2026. As long as it happens, we are going to make a lot of money for our clients. So conviction is important. And the other important thing, is India is now at $2,000 per capita. And what is the global experience actually showing? The global experience actually shows that this per capita business is like a video game which we played when we were kids. Because as you know, in a video game, as you become a better and better as you become a better and better player, you will find that new and new tools open up. You become more powerful. The game, of course, becomes faster, but as you play for longer, as you make more points, you become a better and better player. So this per capita business is exactly like that. At $2,000 per capita, we are just about becoming a stronger player. But see what happens to the economy when it hits $5,000. By the way, mobility and automobile as a sector comes into play only when an economy gets to $5,000 per capita. Recreation, travel, tourism, the real consumption of electronics actually starts when an economy hits $8,000 per capita. So, nowadays, a lot of times people say that, oh, the automobile sector penetration is not there, it's done and dusted. I think it's laugh worthy. The fact is that most of the sectors haven't even begun their journey as far as India is concerned. So it's very, very important to demonstrate conviction to clients. I think foreign money is going nowhere. Foreigners are not going to keep selling. You will see that they'll buy back more than what they have sold. And you will actually see that people make a lot of money over the last 5 to 10 years. And like I demonstrated, foreigners have already made a lot of money in India over the last 5 to 10 years. And even though India's per capita income is $2,000, the fact is that within India, there are many Indias. So most of the states on this chart, many states on this chart, you will find two things. One, a lot of them are already well over $2,000 per capita. So for example, if you are in Tamil Nadu right now, Tamil Nadu is $3,765 per capita. It is equivalent to Vietnam's per capita income. But what it is interesting is that Vietnam doesn't have 22.5 crore people. Whereas in that per capita bracket, we have 22 crore people, right? So I think this is something which we must really look at, and this is something which we should use to drive conviction with our clients. The second area from where a lot of negativity seems to be coming in the market is related to tech sector. We don't need to, so we don't invest in all of these companies which are seen on the screen out here, and we are not invested in all of these companies which are probably seeing their share prices go up and down. But let me tell you one thing, that today it has become very fashionable to say that technology is a bubble. Let me clarify two things. The evolution of the tech sector in India has nothing to do with the evolution of tech sector in US. COVID was a 2 week phenomenon in the US. Barring that, they've been on a rally for the last 12 to 13 years. In India, a rally has started only in the last 1.5 years. And what is our tech sector and what kind of money tech companies are going to make in India? Look at this. In India today, say 2020 data, India had 137 crore people, 70 crore 4G connections, 22 crore OTT users, 16 crore online transactors, 4 crore users of Ola, Uber, and the online food delivery type of vehicles, and 1 crore users of education technology. And where will we be in 2025? We will have probably, I don't know about all the other numbers, but this number will be met. We will have 145 crore people, 111 crore 4G connections. We will actually have 12.5 crore users of ride on demand and online food delivery. We'll have 6 crore users of ed tech or education, online education, 30 crore online buyers, and we'll have 111 crore 4G connections. So let me tell you one thing as far as tech sector is concerned. Don't make the mistake of comparing it with US. US nearly doesn't have these statistics. By the way, as far as payments are concerned, India is ahead of US and China. And India's tech sector, we may not have the Facebook and Google of the world, but India's tech sector is going to be offer way more potential than anywhere in the world. So, you can pick up 1 or 2 IPOs which got listed and their share price went down. You can keep criticizing based on valuations and business models and what kind of comments managements are making, but ignore the tech sector at your own peril. I think this is going to be hugely transformational for one simple reason, that 5 years back, 10 years back, technology was used only for efficiency and cost advantage. Today, whether it is your business or my business, technology is not used just to give cost advantage, not used just for efficiency. Today, technology is used purely in order to gain a competitive advantage and to execute better than our competitors, then your competitors, our competitors, or competitors in any industry or any landscape. So what we should keep in mind, the basic reason for investing in technology by businesses has changed dramatically over the last 5 years. It's no more for efficiency or cost savings. It is for competitive advantage. Tech is the business, or digital is the business, or business has become digital. So while we strive to serve our customers, I think technology can be a competitive advantage. So like I mentioned, fine to criticize companies and share prices, but ignore at your own peril. Try to study this, try to ensure clients participate in this. A lot of people are worried about how much the market has gone up. This is just a visual representation. How does this rally compare to the others? This is where we are right now. It's nothing. When the EPS multiplies, indices multiply. And coming to EPS, this is something which I want to share with you. In the last 7 to 8 years, the earnings per share of Nifty companies was consistently between 400 to 450. And that's why you saw the Nifty between 8 to 12,000. I think today, the bracket is not 400 to 450. We have moved from 750, 850. We have moved to the 750, 850 kind of range. So the range of Nifty, which was 8,000 to 12,000, that itself has shifted to becoming more like 14,000 to 20,000, or 14,000 to 22,000 actually. So the numbers have changed, the market range has changed, and many, many fundamentals have changed. So keep conviction and don't get carried away by what the crowd is actually talking about. The last couple of charts, which I'll tell you, which is related to how you can produce alpha from being in the right beta. Till now, I was talking about showing conviction and being a contrarian and not getting carried away with the crowd. But how to execute this? I think always remember this chart. Keep this chart in mind. It clearly shows you that what is the average 1-year rolling return on a particular asset class, and what is the level of fluctuation or what is the level of volatility in that asset class. And it's very, very imperative that when we create portfolios for clients, we don't categorize clients as risk-taking or risk-averse. We just have to categorize clients as various combinations of risk and return. And we need to mix up all of these asset classes and ensure that there is fair mix of each of these in clients' portfolios. The other thing which is very important to keep in mind, that when we make asset allocation, we do not need full correlation and we do not need negative correlation. What we need is to mix up asset classes which have actually low correlation. So for instance, if you were to take US equity and gold as a combination, it shows very, very low correlation. If you were to take, for example, Indian equity and you were to take, for example, gold, again, very, very low correlation. So it's very important that to provide stability and low fluctuation to client portfolios, we need to mix up the asset classes. This is a very simple example I've taken from my colleagues from my previous organization. Credit to Aashish Shankar, who's part of my previous organization. But what he did was very, very interesting. He has basically made an equal weighted portfolio of all asset classes. What are these asset classes? India equity, US equity, debt, cash, and gold. And then over the period of 30 years, over a period of 30 years, he has taken that for equal weighted combination, what type of returns would you generate? And what is interesting to know is that at most points in time, more than 52% of the times for a 3-year holding period of equal weighted asset classes, 52% of the time, the return falls between 10 to 15%. It is never negative. And if you add these up, it is positive at least 90% of the time. So I think this is the power of asset allocation. This is the power of the fact which I mentioned, that alpha comes from being in the right beta. And I think rather than focusing on narrow areas or short-term things, I think what is most important is through our conviction, through clarity of thinking, and through being a mild contrarian, you can add a lot of value into client portfolios. So thank you very much for listening me out. It's been a pleasure speaking to all of you. I wish you all the best. Thank you.